Assalamualaikum warahmatullahi wabarakatuh and a very good day to everyone. We are Group 5 representing topic Inventory Management and Accounting. Before we go further, let me introduce our team members. There are Zainatul Farihin, Izzah Nadira, Nur Adibah, Nur Atira and me, Nur Ayuni. In this topic, there are several subtopics that will be explained later.
My name is Zainatul Farihin binti Haslan. So today I will be talking about the inventory and accounting on the definitions. Inventory can be defined from an accounting or operations perspective. From accounting view, inventory includes those assets that are used to generate revenue and that will be converted to cash in the short term. In the case of hospitals, medical supplies, and pharmaceuticals, regardless, most medical supplies and drugs are reimbursed either directly or indirectly, and therefore they represent costs incurred that will deliver future benefits. From an operations perspective, inventory represents a margin of safety to protect the business from unpredictable levels of demand. Without inventory, hospitals could purchase just enough products to sustain normal operations. But if one more incremental unit was used or consumed, then the entire supply chain would be thrown into chaos due to a lack of supplies needed to provide services known as stockouts, reduced service levels, and a potential inability to fully treat a patient. In operations terms, inventory is a buffer against demand variability. Operationally, inventory serves a multitude of other functions. Inventory improves customer service by making products available immediately. It allows for economics of scales as it encourages aggregation of production, purchase, and transportation to achieve reduced costs. Inventory takes advantage of pricing discounts for large quantities. For most manufacturers and distributors, it is significantly easier to work in larger volumes or batches compared to smaller quantities. This is because manufacturers produce in large batches to reduce production costs, and distributors receive quantity discounts for buying in volume. Next, inventory protects against demand volatility. When demand is less than certain or variable, inventory helps protect against this variability. Inventory also helps accurately report financial results because the timing of the supply expense must be associated with the period in which revenues are generated. Finally, inventory hedges against price changes. If a supply cost is increasing at a greater rate than the average consumer price inflation of 3%, it is sometimes beneficial to hold larger volumes of inventory as a hedge against the risk of rising prices. Let's move on to the inventory challenges. The biggest reason not to hold excessive inventories is that they consume cash and capital resources that might be put to be produced elsewhere. Cash spent on supplies that once spent cannot be used for other purposes. If a hospital does not need an item until some period in the future, the most optimal case is that the item is not procured or delivered until as close to point of need or consumption as possible. This is called postponement. Another reason not to hold inventories is that they often hide problems, especially in systems that are not working properly. Lower utilization rates and slow cycle times and otherwise unproductive processes are often masked by inventory. Lastly, it increases in cost for the inventories that are not being used, which can result in the risk of loss or spoilage other than taking space for the storage where required.
So, what is the difference between supply and inventory? There is really a distinction between supply and inventory in terms of timing and chargeable. So, let's look into the terms of timing first. Supply is purchased and consumed in the same period, where it means we consume directly when we want to understanding the process or treatment. To illustrate, we purchased $1,000 of such a package during the month of April and all the items were used in the same month, while inventory is more to stock up. It means we purchase, then we stock up to keep in our organization as it can be used later on. For example, we purchased $1,000 of suture in April, but half of the item that were not used as of the end that month, so the remaining or unused portion will carry forward to the next month. That was called capitalized inventory. For chargeable, supply can be reimbursable by payers or not. Chargeable here means that if the purpose of the material is to charge it back to directly, which can be a service product or department, and indirectly, which can be through room rates or procedure fees to patient. If it not consumed by the end of that period, it was held as inventory. Next, move to the criteria for recurring inventory. These are the list of the criteria for the operation or material manager to look through. The criteria that list is important in order for us to record or to have a proper documentation of our inventory. The criteria of recurring inventory also help us to decide for a supply to become an inventory.
My name is Zanadira and we're going to look at the difference between periodic inventory and perpetual inventory. Periodic inventory is physical counting and observation of goods, while perpetual inventory keeps a running record of inventory balance on hand. There are several differences between periodic inventory and perpetual inventory. First, account. Under a periodic inventory system, there is no cost of goods sold account entry at all in an accounting period until such time as there is a physical count, which is then used to derive the cost of goods sold. While under the perpetual system, there are continual updates to either the general ledger or inventory ledger as inventory related transactions occur. Next is computer systems. The simplicity of a periodic inventory system allows for the use of manual record keeping for very small inventories. It is impossible to manually maintain the records for a perpetual inventory system since there may be thousands of transactions at the unit level in every accounting period. Next, cost of goods sold. Under the periodic inventory system, the cost of goods sold is calculated in a lump sum at the end of the accounting period by adding total purchases to the beginning inventory and subtracting ending inventory. Under the perpetual system, there are continual updates to the cost of goods sold account as each sale is made. Next is cycle counting. It is impossible to use cycle counting under a periodic inventory system since there is no way to obtain accurate inventory accounts in real time, which are used as a baseline for cycle counts. Next is purchases. Under a periodic inventory system, all purchases are recorded into a purchases asset account, and there are no individual inventory records to which any unique count information could be added. Under a perpetual system, inventory purchases are recorded in either the raw materials inventory account or merchandise account, depending on the nature of the purchase. While there is also a unit count entry into the individual record that is kept for each inventory item. Next is transaction investigations. It is nearly impossible to track through the accounting records under a periodic inventory system to determine why an inventory related error of any kind occurred since the information is aggregated at a very high level. Conversely, such investigations are much easier in a perpetual inventory system where there are transactions are available in detail at the individual unit level. Accounting entries for supply and inventory. Basic equation of inventory is BI plus P minus COGS equals to EI. BI beginning inventory, P purchases, COGS cost of goods sold, EI ending inventory. Let's take a look at the example. The example need adjustment, which is shrinkage, made when the comparison of general ledger to actual observed quantities shows material variances. Shrinkage is a result of failure to charge out properly to patients as items were dispensed or utilized, misplacements or overuse of drugs or supplies, items that have passed the expiration date or are obsolete and therefore have no value, loss due to theft, pricing or value decreases, and any other general loss. These are the costs that we need to do the shrinkage.
My name is Nur Adiba binti Abdul Rashid, and I will continue the presentation with the inventory loss. From the accounting perspective, inventory is an asset. Inventory loss occurs when the number of products in stock are fewer than those recorded on the inventories. The factor that attribute to the loss of inventory or shrinkage is first, failure to charge out properly to patients as items were dispensed or utilized. The hospital failed to properly charge the patient because the item has been removed or used. This incident happened because of the person in charge's carelessness. Next is misplacement or overuse of drugs or supplies. The authorized person might forget where they put the drugs and needs to take the same drugs twice to pass it to the patient. The other factors is items that have passed the expiration date or are obsolete and therefore have no value. Pharmacy needs to dispose their drugs if it nearly the expiration date, and this is an inventory loss as the drugs are not fully used until the end. Furthermore, inventory loss can caused by a theft and it may come from the outsider or insider themselves. Last but not least is the pricing value decreases. Okay. Inventory ratio helps the company know how many times a certain company has to replace or sell the stock within a time frame. The metric should be continuously monitored and tracked for both supplies and inventory to ensure the operating efficiency. One of the key ratios used in hospital is days of supply or DIO. This metric is to measure the amount of inventory on hand relative to an average daily usage. To get these days of supply, we need to divide the total number of units on hand to average daily units used. For examples, if there were 800 of shillings on hand and the average daily units used is 100, the DIO would be 8 days. Next, we're moving on to the other useful metrics to measure liquidity, which is inventory turnover. The formula is COGS divided by average inventory. Okay, next is calculate the gross margin percentage, where this ratio allows tracking of the relative importance of supply costs on hospital supply revenue. To get this, the first one is net supply revenue minus COGS and then divide to net supply revenue. Lastly, if material management department fully charge for all hospital supplies, another useful metric is return on inventory. This metric examines the net income effect of inventory, and to calculate it is net income divided by inventory. Moving on to the next slide is the other inventory calculations. We have been go through to 4 of inventory ratio calculations. So these are the other important inventory calculations that can be used to monitor asset utilization and improve operational efficiencies. The first one is to calculate the safety stock, where the purpose is to carry additional inventory to satisfy unexpected demand. The calculation is as shown in the slides, where S stands for the standard deviation of a sample of errors from the sales and forecast history. Next, P is the desired customer service levels, and Z is the value or number of standard deviations from the mean on a normal distribution curve for a specific service level. The higher the Z value, the lower the risk of stocking out. The second calculation is to measure the probability and item available needed. The formula for customer service level is as shown in the slide, where Q is the order quantity, E is the expected number of units short, and Z is the number of standard deviations of safety stock. Next is economic order quantity, or EOQ, which define the optimal amount of inventory to reduce overall inventory carrying costs and reduce working capital while maintaining adequate service. This calculation is one of the best solutions to minimizing the amount of inventory on hand, the cost of ordering goods, and the carrying cost of inventory. It affects the order lot size, or the average quantity in units that a company should buy at a specific moment to benefit from economies of scales. Lastly is cycle inventory. Cycle inventory is used to manage the effects of lot size that cannot be matched to demand. The calculation is very straightforward, where the lot size divided by 2.
Hi, my name is Nur Atira binti Muhammad Hamidun. I will be presenting about the inventory policies. This subtopic discusses the various inventory policies and procedures required in hospitals. These are all the policies listed for the hospital to follow in making sure that inventory is managed and valued completely. So, I will be explaining about each of the contexts needed in the policy of a hospital. Capitalization criteria and valuation methods. The first policy focuses on how the hospital should prioritize which inventory to capitalize for and is listed as an asset in the balance sheet. Periodic versus perpetual system. If not covered in other policies, this section should address the preferred and authorized methods of inventory accounting, including perpetual and periodic methods. Definition of supply versus inventory. This policy certainly falls under one of the earlier policy described, but it should specify when to expand versus capitalize supplies. Inventory reporting requirements, timing and nature of management reporting. This policy should outline the format, frequency and types of the management reporting, as well as permissible benchmarks and KPIs. Instruction for cycle counts and periodic physical inventory counts. This policy should include information about cycle counts, whether they are utilized in a perpetual or periodic methods, and explain how to administer them, what pre-count instructions are necessary, what kind of documentation is allowed, and how to report timelines back in the general ledger. Moving on to the next slides, I will resume my explanation with the other 6 policies. Treatment of obsolete inventory. The accounting for obsolete inventory should specify in this policy. Obsolete refers to a product whose useful life has ended. This policy should specify the accounting treatments that will be used, the physical disposition of the inventory, and the logistic for reverse flow. Management of consignment inventories. This policy should outline the precise placement of consignment inventory, the steps for making notes or entries into non-general ledger systems, and the broad division of owned from committed inventories. The use of systems which include RFID and barcode. This policy should set the groundwork for the deployment of systems that adhere to real-time, perpetual inventory management practices, standard coding techniques, and essential automation criteria. Receiving of materials into inventory. This policy specifies the accounting entries required to increase inventory, how to maintain and manage inventory once it has been acquired, and how items are systematically received into a hospital resource system. Treating shrinkage and suspected inventory losses. In addition to describing the paperwork needed in the event of theft, this policy also covers the financial entries needed to justify shrinkage and loss. Procedures for preventing losses should also be listed here. Inventory measurements and metrics. This policy establishes the necessary inventory computations, including permitted data sources, a description of the measure, and a definition, and that must be controlled by each inventory location. I will continue to explain about the inventory planning. Effective inventory management, sales and operations planning, collaborative planning, forecasting and replenishments are all depends on accurate inventory planning. It is essential to establish safety and cycle inventory policy levels, acquire the appropriate quantity of goods at the point of need or consumption, assess demand and plan inventory positioning appropriately, and construct efficient replenishment processes based on cooperative demand plans and inventory policies in order to buffer the variability in supply and demand environments. Priorities are determined by the ABC analysis based on volumes, margins, turnover, needed services levels, or another pertinent statistic that illustrates relative importance. Vendor Managed Inventory (VMI), which enables the supplier to control inventory stocks levels for its customer based on anticipated usage or demand, is a useful tool for improving inventory planning.
Last but not least, the inventory management expectations. First is the inventory utilization. This performance indicator measures how efficient the group is in delivering and managing overall inventories for the organization. The metric is defined as both the total inventory values as well as the DIO, which is a better metric for measuring inventory when patient volumes are growing. Tracking current DIO, setting a targeted level, and then managing toward that goal improves inventory utilization. Second, order fulfillment efficiency. This measures the efficiency of a department's picking, packing, and handling process. It should be measured as both the overall cycle time for fulfilling orders as well as the number of items picked per hour, plus any number of other metrics available. Similarly, fill rates can be used. Third is revenue management. Inventory is responsible for maximizing revenue sources such as for pharmaceutical items, medical supplies, or durable medical equipment. Capturing 100% of the potential revenues and minimizing the associated expenses is the goal. Tracking the return on inventory as calculated earlier ensures that inventory is successfully generating revenues for the organization. Finally, operational effectiveness. This metric measures the extent to which the department is effectively performing a variety of activities necessary to continually improve, including setting optimal inventory levels, including the creation of forecasts and plans with the key vendors and distributors, monitoring product mix and key item usage, including the development of ABC inventory classifications, and finally ensuring 100% customer service levels.